So if you're trying to save for retirement and are looking for the best way to guarantee that you'll have enough money to last you those 20 or 30 years or more while you're retired without, of course, running out of money, then you're probably going to want to watch this video. Hi, my name is Rajiv Rebello from Guaranteed Annuity Experts, and today I'm going to show you exactly why Guaranteed Lifetime Income Annuities, or GLI Annuities as we'll be referring to them in this video, are such great retirement planning tools. And more importantly, how you can use them to increase your chance of having a successful retirement. So what exactly are GLI annuities doing that make them such powerful retirement planning tools? At the core, GLI annuities are taking that bond part of your portfolio and making it more tax efficient with higher after-tax yields and less risk. Most people don't realize that when you purchase an annuity, you are basically investing in the long-term bond portfolio that is being managed by the insurance company with additional benefits that you are not getting from your current retirement bond portfolio. This is why in our case study, John and Sally went from a 56% chance of meeting their retirement income goals without using a GLI annuity to a 74% chance of meeting their retirement income goals when they did use a GLI annuity. They also increased their expected after-tax wealth that they would leave to their beneficiaries or spend later in life from 1.5 million to 7.1 million. So let's go ahead and look at the 5 benefits that you get by investing in a bond fund through an annuity that you just can't get when you invest in a regular retirement bond fund. The first is higher pre-tax yields. The second is a guarantee against loss. Third is a lower tax liability. The fourth is more growth in your equity portfolio. And the fifth are arbitrage benefits that come from risk pooling. Let's go ahead and look at each of those 5 reasons that I gave earlier in a little bit more detail. So the first key benefit that you get when you invest in a GLI annuity over a taxable bond fund are higher pre-tax yields. You see, when you invest in bond funds as part of your retirement portfolio, you're typically investing in lower earning, shorter term and intermediate term bonds to avoid risk. However, when you invest in an annuity, you're essentially investing in a longer term bond fund, which is typically higher earning. Plus, you're receiving additional benefits from the return of principal and risk pooling benefits that annuity products provide you cannot get elsewhere. Let's kind of go over this by quickly looking at a slide here. The first key benefit that we'll be talking about here are the higher pre-tax yields that GLI annuities provide over a taxable bond fund. And again, we can see this here in this short little table to the right. If you look at your retirement bond portfolio, as we mentioned, they're typically investing in shorter term or intermediate term bond yields. So as of now, it's probably around 4.76%. However, if you were to invest in that bond portfolio in a GLI annuity, your pre-tax yield would be 11.65%. So that GLI annuity provides more than double the pre-tax yield that you're probably getting right now in your retirement bond portfolio. Another key benefit that GLI annuities have over a taxable bond fund is lower risk. Most people don't realize that when you invest in bond funds within a portfolio, you are still subject to credit risk, default risk, and interest rate risk. What this means is that there is a chance that you may not get the full returns you thought you were going to get from your bond portfolio. However, when you invest in a bond fund via an annuity, the insurance company protects you from this risk. They are providing you with guarantees and protections that you simply just can't get elsewhere. Now let's look at another slide with our previous pre-tax yields, and let's consider risk along with those yields. In other words, the risk-adjusted yield or risk-adjusted return. Here in the slide, we can see that the GLI annuity provides the highest risk-adjusted return because the GLI annuity is both providing a high pre-tax yield as well as guaranteeing the consumer against a loss. And so what I tried to illustrate here is an example is if you're investing in this 10-year high-quality corporate bond and interest rates go up by 1%, then you'd lose about 8% of your investment. However, if interest rates go up by 1% and you're investing in a GLI annuity, the insurance company is protecting you against that risk. So the GLI annuity is both providing higher yields and lower risk. In other words, they're maximizing your risk-adjusted return. So the GLI annuity provides both higher pre-tax yields and protects clients against a loss in their portfolio. The next benefit to consider is the fact that GLI annuities provide higher after-tax income than bonds. And this is because when you use a GLI annuity, you are drastically reducing your tax liabilities. This is due to two reasons. The first is that a GLI annuity defers income from your bond portfolio from when you are in a high tax bracket while you are working to when you are in a low tax bracket while you're in retirement. The second reason is because with a GLI annuity, you get part of your principal returned each year. However, with a regular bond, you have to wait until the end of the term until you get your original principal back. And remember that this principal amount that's being returned to you is not taxable. Both of these reasons mean that when you're using a GLI annuity, you're getting more after-tax income than you would with a taxable bond fund. Let's go into these points in more detail with two quick slides. So on this first slide, what I want to focus on the benefit of tax deferral. So we're going to look at that bond portfolio and the gain from that bond portfolio and see the drastic reduction in taxes that happens when you defer the taxation until you're in retirement and a lower tax bracket. So in this example, we're looking at the bond gain, and John and Sally have $54,000 worth of bond gains that are taxable to them. However, the problem is that they already have $500,000 in W-2 income, which means that this additional $54,000 is going to be taxed at a very high rate. So we can see in this case, while they're working, John and Sally are losing about $24,000 of this $54,000 bond gain to taxes. And so their net income is only about $30,000. So that's a total tax rate of 44%. Again, that's high because John and Sally live in California, so they're paying federal taxes. They're paying high state income taxes, and they're paying a net investment income tax on that as well. However, if John and Sally were able to defer this $54,000 until they're in retirement when they have no other W-2 income, then the total taxes paid on this $54,000 would only be about $36.64. In other words, their net after-tax income is $50,000. So their tax rate is under 7%. Again, that's a $20,000 difference in savings simply by deferring the taxation until they're in retirement in a lower tax bracket. Again, deferring income until you're in retirement can increase after-tax income on your bond gains by 60% or more. So that's a key value, is this tax deferral. So the next thing I want to talk about is the fact that GLI annuities are less taxable. And that's because, as we mentioned earlier, when you get income from a GLI annuity, not all of that is taxable because part of that is principal. Unlike with a bond coupon where every year you're paying taxes and it's 100% tax liable. So again, let's just quickly summarize this with this table here below. So again, we're comparing a 10-year high-quality corporate bond with a GLI annuity. As we talked about at the beginning, the yields are significantly higher with a GLI annuity. Of that yield, however, 100% is taxable when you invest directly in a bond fund. However, with a GLI annuity, only 73% is taxable. On top of that, like we talked about, the tax rates are not the same. For the first 10 years, from age 55 to 65, while John and Sally are working, they're losing 44% of this bond gain, which is already lower, right? It's already a lower yield to taxes. Obviously, when they retire, they're only losing about 18% of that. However, with the GLI annuity, John and Sally are deferring all of their bond gains until they're in retirement. So they're only paying 18% on all of that. So that first 10 years, they're essentially saving that 26% difference in the tax rate. Again, the higher pre-tax yield combined with the fact that only part of it is taxable, and of course they're paying a lower tax rate here, that means that if John and Sally, the last one dies at 93, which is their life expectancy, by using a GLI annuity, John and Sally are getting a 6.26% after-tax return on their investment by using a GLI annuity. Whereas if they were to just stick with the corporate bond they would only be earning an after-tax IRR of 3.45%. So again, the GLI annuity provides higher pre-tax yields and less taxation on that yield, allowing for clients to earn significantly higher after-tax IRRs by using a GLI annuity than investing directly in a bond fund. So the fourth reason that GLI annuities are better than investing in taxable bond funds is that since you are getting more after-tax income from the GLI side of your portfolio, this allows the equity side of the portfolio to compound more over the long run. And since the equity side of the portfolio is more tax efficient and typically higher earning over the long run, that leads to more after-tax wealth over the long run. And clients can, of course, use that increase in after-tax wealth to either spend more in their later years of retirement or simply to pass on that wealth to the next generation. So again, let's take a look at this in the next slide. So here in this slide, we can see, again, the client's going to have more growth from the equity side of the portfolio when the client uses a GLI annuity than when they just use a regular taxable bond fund. So the orange line shows the median portfolio value when the client is just using a taxable bond fund. So we can, and then the blue line is, of course, if they replace that taxable bond fund with a GLI annuity. So what's happening here is that both John and Sally are working at age 55, right? For the next 10 years, they're working. So the portfolio values are about the same at the time they retire at age 65. And then in the earlier years of retirement, the taxable bond fund is actually doing a little bit better. Again, that's because we're investing in the annuity and there's sequence of return risk. So, however, in the later years, what's happening is that the portfolio that's using the GLI annuity, again, the blue line, is taking off. And that's because the GLI annuity is providing more pre-tax yield and less taxation on that yield, along with the fact that it's lower risk, right? It's a guaranteed return. You're getting that every year, regardless of the market. So over time, the portfolio that's using a GLI annuity is increasing in value, whereas the portfolio that's just using a taxable bond fund is decreasing in value. Again, the 60-40 portfolio is not enough to sustain the client's spending rate of $250,000 a year with inflation indefinitely, right? So they're going in different directions. And that's the value of using a GLI annuity is, right? You're getting so much income, after-tax income from the GLI side of the portfolio, it allows the equity side to compound over the long run. And as we know, over the long run, by investing in longer horizons, you both increase the wealth that you're able to compound as well as reduce your risk because you have a longer investment horizon. And that's, again, the value of using a GLI annuity is this more after-tax wealth. You're getting a higher chance of meeting your retirement income goals like we've shown, as well as more after-tax wealth in the later years of your retirement. So the last reason why these products are so great is that they provide arbitrage benefits and risk pooling benefits for the people who use them properly. And that's because a lot of people pay into the system for these benefits, but not everyone really uses them. It's kind of like a subscription service that everyone pays for, but not everyone uses. Think of your gym membership or your Netflix subscription. If everyone went to the gym all the time or used Netflix all the time, then the cost of the gym or your Netflix subscription would be so much higher. But that's not how these services work. Every user pays the same price regardless of how much or how little they use the service. This means those who use the service a lot are getting the benefit from those who barely use the service. It's the same with GLI annuities. Some people who use the product properly are getting a significantly better deal and higher yields than they would otherwise. And this is all because a lot of people are purchasing the product and not using it properly. So the benefits that would have gone to them, these people who are not using it properly, are going to the people who are using it properly. And so what we do here at Guaranteed Annuity Experts is show you exactly how these products work and how you can use them properly. The other benefit about these products is that they're just not underwritten. So if you're in good health and buy these products, you're getting the benefit from people who are in poorer health and buy these products. The longer you live, the more you benefit from these products. These are just not benefits you can find elsewhere, and why you get much higher returns from using GLI annuities than you can get elsewhere. Let's take a deeper look at this on the next slide. So in this slide, we're going over arbitrage benefits that you can get from a GLI annuity that can't be found elsewhere. Again, risk pooling benefits the wealthy or the sophisticated investor. So the first is that wealthy people or healthy people, sophisticated investors typically live longer. Again, there's a mortality credit benefit. However, again, we mentioned that people aren't using them properly, so you don't have to live that long to get the benefit. In this case, in our case study, John and Sally only have to live past age 78. So only one of them has to live 78. So there's a 98% chance that one of them will live past that. Again, as we'll talk about, that's because people aren't using it properly. The other reason why this risk pooling benefits the sophisticated investor is that the sophisticated investor doesn't have a sudden need for liquidity. They've done proper financial planning and retirement planning And they don't need to all of a sudden sell down their portfolio to meet their needs, or they don't have to worry if there's a sudden crash in the market that all of a sudden they have to sell a large part of their portfolio to meet their income needs. They've met that through the GLI annuity. The other reason why these risk pooling benefits benefit the sophisticated investor is that they have access to better educated life insurance and annuity professionals like us at Guaranteed Annuity Experts, who structure these products better and explain to you not only which products to buy and which are the good products and versus the bad ones, but when to use them, when to optimally take the benefit. The other reason sophisticated investors benefit from these products is that they exercise these options. They exercise the benefits, like the guaranteed lifetime withdrawal benefit that, again, everyone else pays for, but not everyone uses. The other reason why people benefit is, of course, if you're in a high tax bracket. The higher tax bracket you're in, the more the tax savings are from this type of product. Again, the reason why some people benefit at the expense of others is because everyone's paying into the system, but not everyone's receiving the benefit, right? And so it's understanding that which product is for you and making sure you use this benefit properly. So less sophisticated individuals pay into a system so that sophisticated investors can reap the benefit through what's otherwise known as financial planning alpha. This is why in our case study, John and Sally are so much better off by using a GLI annuity for their retirement planning purposes than a taxable bond portfolio. So let's summarize again why GLI annuities are such great retirement planning tools in comparison to taxable bond funds. The first are higher pre-tax yields. The second is a guarantee against loss. The third are lower tax liabilities. The fourth, more growth in your equity portfolio. And the fifth are just arbitrage benefits that come from risk pooling that you just can't get elsewhere. If you're interested in working with us, just reach out to us via the link in the description below or send us an email at hello@guaranteedannuityexperts.com, and we'll help you determine if a GLI annuity is the right fit for you, and more importantly, we'll be able to quantify how much better your retirement planning will be because of it.